A business can look profitable on paper, show strong revenue for the month, and still leave you staring at your bank account, wondering where all the money went. If that keeps happening, it usually means you don't have a revenue problem, you have a cash flow problem. In this video, I'm gonna make the difference very clear, because once you understand it, you stop running your business based on hope and start running it based on what's actually in the bank. First, I'll explain why business can show profit on paper, but still feel broke in the bank, and why this happens to more businesses than you think. Then I'll walk you through 3 main reasons revenue never actually turns into cash, including one that surprises a lot of business owners. And finally, I'll show you 5 simple numbers you should be checking every month, so you always know where your business stands financially and don't get caught off guard. Now, the reason this happens is because every business is actually telling 2 different stories. The first story is told by your income statement. That report answers a simple question: did the business make money? It tracks your revenue, your expenses, and your profit left over. But there's a second story being told at the exact same time, and that story is told by your bank account. Your bank account answers a much more immediate question: is there actually cash in the business right now? And those 2 stories are not always the same. A business can actually show a profit on paper while the bank account is slowly draining. This disconnect is where most cash flow problems begin, because profit tells you if the business is working, but cash tells you if the business can survive. One of the most common assumptions business owners make is this: if the business made $10,000 this month, there should be $10,000 in the bank account. But that's not actually how business works. Revenue only tells what the business earned on paper. It does not tell you what money actually hit the bank account or what money is about to leave it. And the gap between revenue and actual cash is where many business owners start to feel confused. Because on the surface, everything can look good. Sales are coming in, work is getting done, invoices are going out, but the bank balance still feels tight. And when that keeps happening, it usually isn't because the business isn't selling enough. It's because the owner doesn't yet see the full picture of how cash is actually moving through the business. In fact, studies consistently show that around 82% of small businesses that fail report cash flow problems as a major reason. Not because they had zero revenue, but because revenue, expenses, and cash timing were all happening at different times. A business might look profitable on paper while the bank account is slowly shrinking. That's why understanding cash flow is so important, because revenue shows you activity, profit shows you if the business model is working, but cash tells you whether the business can keep operating tomorrow. Once you understand that difference, the next step is figuring out why revenue doesn't turn into cash. And in most small businesses, it usually comes down to 3 main reasons. The first reason revenue doesn't turn into cash is actually very simple. You haven't collected the money yet. This is where a lot of business owners run into problems, especially if you invoice customers or get paid after the work is completed. Let's say you just finished a job for a client and send them an invoice for $10,000. From an accounting standpoint, that revenue can already show up in your income statement. On paper, the business just made $10,000. But the client might not pay that invoice for another 30, maybe even 60 days. Meanwhile, your expenses are still happening right now. Payroll needs to be paid, fuel for vehicles, materials for jobs, software, subscriptions, insurance, rent. All those costs are pulling money out of the bank immediately. So even though the business technically earned $10,000, the cash hasn't actually arrived yet. And this situation is extremely common. Recent business research shows that more than half of small businesses are currently waiting on unpaid invoices, with the average amount owed being around $17,000. So when owners say something like, "We did a lot of work this month, but the bank account still feels tight," this is often the reason. The money exists on paper, but until that invoice is actually paid, it isn't cash. In accounting, that money sits in something called accounts receivable, which simply means money your customers still owe you. And if those receivables start getting older, 30 days, 60 days, sometimes longer, cash flow pressure builds very quickly. The second reason revenue doesn't always turn into cash is that even though the money doesn't hit the bank, it's often already spoken for. Most business owners are very aware of the direct cost of doing a job, things like material, labor for the project, or immediate expenses required to deliver the work. But what often gets overlooked is the amount of overhead quietly pulling cash away from the business every single month. And these expenses happen whether you had a big sales month or a slow one. Things like payroll taxes, software, subscriptions, insurance, rent for your office space, marketing expenses, merchant processing fees, accounting and legal services, state and federal taxes for running the business. Individually, none of those feel huge, but collectively, they can create a constant drain on cash. This is why two businesses can generate the exact same revenue and still have completely different financial health. One owner understands every expense in the business, and the other only looks at revenue. Personally, I make it a point to know every single subscription and overhead cost tied to the business, because those expenses add up quickly. If revenue comes in but overhead is quietly growing at the same time, the cash disappears faster than most owners expect. And that's why revenue growth alone doesn't always fix a cash problem. Sometimes the real issue is that the business simply has too many expenses pulling from that cash as soon as it arrives. The third reason that revenue doesn't always translate into cash is that sometimes the money leaves the business in ways that don't show up clearly on the income statement. This is where a lot of business owners get confused. They look at their profit and loss report and think everything looks fine, but the bank account keeps going down. And the reason is that not every cash movement shows up as typical expense on the P&L. For example, loan payments. Let's say your business loan payments is $1,000. Your bank account loses the entire $1,000, but the income statement, you might only see the interest portion, maybe $100 or $150 as the actual expense. The rest of that payment is simply reducing the loan balance, so it doesn't appear as a normal expense. Another example is owner draws or distributions. When you move money from the business account to a personal account, that cash leaves the business immediately. It usually doesn't show up as a standard operating expense. Equipment purchases can do the same thing. If a business buys a $10,000 piece of equipment, the bank account loses that money right away. But the accounting rules often spread that cost over several years. So again, the cash leaves immediately, but the expense on the income statement looks much smaller. Inventory purchases can create the same issue for product-based businesses. You might pay inventory months before the inventory actually generates revenue. All these situations create a gap between what your financial report shows and what your bank account is experiencing. And when business owners don't understand those differences, it can feel like money is just disappearing. But in reality, the cash is simply moving in ways the income statement doesn't make it obvious. When you step back and look at all three of these problems together, you start to see the real issue. Most cash flow problems are really timing problems. The business might complete work today, the invoice goes out today, but the payment may not arrive for 30, sometimes even 60 days. Meanwhile, the expenses of running the business are happening constantly. Payroll taxes, rent, vendor bills, credit card payments, fuel, software subscriptions, insurance, all of these expenses are pulling cash from the bank on a regular schedule. So even if the business is profitable on paper, the timing gap between money coming in and money going out can create serious pressure. And what surprises many owners is how little buffer most businesses actually have. Research from the JP Morgan Chase Institute found that roughly half of small businesses operate with fewer than 15 days of cash buffer available. That means many businesses have only about 2 weeks of expenses in the bank before cash becomes a problem. So if a few invoices get paid late or expenses spike unexpectedly, things can start to feel tight really quick, which is why business owners need a simple way to keep their finger on the pulse of cash flow. And the easiest way to do this is by reviewing a few key numbers every single month. So how do you do this to stay ahead? The answer isn't complicated accounting. It's simply having a small set of numbers you review consistently so you always know where your business stands. Here's a simple 5-step check that you can run every month to keep your cash flow under control. Step 1, check the actual cash in the bank. Start with the simplest number first. How much cash does the business actually have in the bank today? Not revenue, not profit on a report, actual cash. This number tells you how much flexibility the business has right now and how much room you have to absorb unexpected expenses or slow payments. Step 2 is review accounts receivable. Next, look at what money is still owed to you. Your accounts receivable shows the total value of invoices that customers haven't paid yet. But the important part isn't just the total. It's the age of those invoices. Look at invoices under 30 days, invoices over 30 days, and invoices over 60 days. If receivables start getting older, that's usually one of the first warning signs that cash flow pressure is building. Step 3, review upcoming bills and payables. Now flip to the other side of the equation. What money is about to leave the business? Look at upcoming obligations like payroll taxes, rent, loan payments, vendor bills, credit card balances, software subscriptions. Seeing these expenses ahead of time helps you prevent surprises and give you time to adjust spending if necessary. Step 4 is check gross profit. Gross profit tells you how much money is left after the direct cost of delivering your product or service. The number matters because gross profit is what pays for overhead. For example, if the business generates $100,000 in revenue, but it costs $70,000 to deliver the work, your gross profit is $30,000. If your monthly overhead is $35,000, the business will slowly drain cash even though your revenue looks strong. So reviewing gross profit helps you see whether the business model itself is actually healthy. Step 5, run a short cash forecast. Finally, look slightly forward instead of only backwards. Ask 2 simple questions. What cash is expected to come in over the next few weeks? And what cash is expected to go out? Even a simple forecast can help you identify problems early. If cash looks tight, you might push to collect invoices faster, delay a non-essential purchase, or slow down spending until things stabilize. Personally, one of the habits that has helped me the most in business is simply staying very aware of the numbers. I make it a point to know every subscription, every overhead cost connected to the business. Software tools, services, recurring expenses, anything that quietly pulls out of the account each month. I also review my books on a regular basis, usually weekly, so I can see where the business currently stands and where things are trending. Because when you do that consistently, you start to see patterns. You can tell when a month might be tight. Maybe the revenue is a little slower or expenses are heavier than usual. In those moments, you can make small adjustments early, maybe cut back on a piece of software that isn't necessary right now, or pause some discretionary spending. On the other hand, when numbers look strong, that's when you can confidently make growth decisions. Maybe bringing in a contractor to help with the workload, maybe investing in more marketing, maybe adding a tool that improves efficiency. The point is, the numbers guide the decision, but running a healthy business also means paying attention to the financial side of things. Because when you understand your numbers, you're no longer guessing about the health of the business. You actually know where you stand. The main idea I want you to take away from this is that a business can generate solid revenue and still struggle financially if the owner doesn't understand how cash is actually moving through the business. Revenue tells you activity is happening, profit tells you whether a business model works, but the cash tells you whether the business can survive. That's why understanding a few numbers is simple. Your cash position, receivables, payables, gross profit, and your short-term forecast can make such a big difference. Because when you consistently review those numbers, cash flow problems almost never appear out of nowhere. You see them building weeks or months in advance. That gives you time to adjust. You can collect invoices faster. You can reduce unnecessary expenses. You can slow down spending until things stabilize. In other words, you move from reacting to financial problems to managing the business proactively. And that's the real goal. Because once you understand where your money is actually going, the business stops feeling unpredictable. You gain control over it. Now, if you want to go a step deeper into understanding your business finances, the next thing you should really understand is how to read your profit and loss statement the right way. Because that report is where most business owners misunderstand what their numbers are actually telling them. Subscribe to my channel so you can watch these videos as they come out and learn how to gain financial clarity in your business.